Well, we just got earnings from Lennar, and it's quite useful to look at the Lennar earnings call to get a peek at what's going on in the housing market. But not only is it useful to look at Lennar, it's also useful to look at the Redfin data center. Because thanks to dropping rates in January, or falling rates in January, we actually ended up getting an interesting data release from the Redfin data center. Take a look at the national median sales price for homes and what's happening here. This is actually some degree of good news. Now, I'm going to explain this in just a moment, but I want you to understand this. My goal is to be neutral about the housing market. I really, for the purposes of my businesses, it does not matter what's going on in housing. It just matters that housing is stable. Nobody wants to catch a falling knife. And we don't need a massive wave of foreclosures to make money in a massive housing crisis. I think that would just prolong the pain and slow down, for example, what we could do with my housing startup. So for my bias up front, I want to be clear, does not matter if housing values massively crash. They already have corrected 15 to 25% in areas throughout the country. But it's very important for us to pay attention to this inflection on screen right here. Because if this trend continues, the potential peak fear that we might otherwise expect in May could soften. Now, we're going to talk about that along with talking about what's going on with the Lennar earnings call. The Lennar earnings call, I would say, is a little bit more on the bad news side, whereas this particular report is very interesting. This is the Redfin data center, and typically what we would expect is that come about May, June, we would expect that year-over-year prices, which is this black line right here, would be negative as they compare to the light blue line on the left if housing were to stay stable at higher rates. However, housing is actually starting to slightly trend up again after the rate drops that we saw in January. Now, for a period of time in February, mortgage rates actually increased again. So it's possible that we could have sort of this drop of this light blue line again, and then a tick up again afterwards. We'll see. It also depends on what happens with inventory, which is, I'll comment on inventory in just a moment. But what I want you to see is that it looks like at the beginning of the year bottomed around 343 here, which if we saw a year-over-year figure from 387 to 343, we'd see a pretty decent correction in nationwide home prices. You could look at individual regions as well to see that some areas are actually doing decently year-over-year, like South Florida is booming. You're basically flat year-over-year, whereas areas like Idaho and Austin, Texas, which is where I am right now looking at real estate, are down about 20%. So you've got a nice discount here already. But take a look at this. You're actually seeing a little bit of a swoop up in pricing right here from 343 to 353, and it's somewhat aligning with this black line right here, which means if interest rates were to continue to fall with mortgage rates, it's possible that if inventory stays as low as it is possible that once we actually get to the year-over-year numbers, that housing prices are actually flattish, not as negative as they are when we compare peak, which is about April, May, to now. So think about that for a moment. Compare April, May to now. Across the board, nationwide average, you're down 10%. Some areas you're down 20%. Some areas you're flat. But if we rise into May and we actually get our year-over-year numbers, we might be flat in May, not actually year-over-year negative. Some areas could actually be positive. A lot of this is because of the belief that housing inventory will remain tight, and it has been extremely tight. Every single market that I visited, and I've been probably in about 50 cities in just the last, 60 days here. I've been in a plane for 70 to 80 hours in just the last 2 months, flying around, exploring different cities, and meeting realtors for my housing startup. And what we're finding in every area is, yes, there are less buyers, but there are also way less homes for sale. Now, that could change. The one place we think there is a change that could happen is institutional-style liquidations. Opendoor, Redfin, REITs, other companies who ended up buying too high that need to liquidate, or even home builders who have a lot of pipeline home building, massive amount of pipeline home building. We have the most pipeline home building that we've seen since about 2006-7 that could end up all coming onto the market around that May-June time. Now, if we have this surge of inventory in May-June at the same time as we get lower rates because maybe inflation is under control, maybe housing could be stable going forward this year. However, if we are in a fear environment where the Federal Reserve has to raise rates higher, inflation is sticky, or the banking crisis worsens, or unemployment increases, then at the same time we have that surge of inventory and we see a reduction of buyers with potentially higher rates, that's how you really set up for more pain. And that's when you could get that year-over-year peak fear. So I'm not making a conclusion here in terms of exactly what is going to happen. Nobody knows that. Anybody who tells you this is exactly what's going to happen, that is, oh, housing's going to the moon or housing's going to crash into a hole, is in my opinion, for some reason, leaning towards dishonesty, because we don't know that. What we know is the data. We know housing prices have corrected 20%. And if prices stay stable, then that year-over-year fear will hit. But if prices rise into the year-over-year comps, then the year-over-year fear won't hit. If prices fall into the year-over-year May comps, then that fear will be even worse. So we don't know. But the trend we're seeing right now, and we're going to look at this Lennar earnings call in just a moment, but the trend that we're seeing right now is that interest rates are coming down on mortgages. People are getting over the quote-unquote sticker shock of high mortgage rates. Yes, we had an adjustment for higher mortgage rates. Yes, there's still a risk that markets can go down more. But as long as we don't get a surge of inventory and rates start trending down, we could actually start seeing people buy earlier. Now, I want to show you the Lennar earnings call because they give us some insights. So a few things that we're going to look at here. First, let's look at the actual Lennar earnings results, and then let's go into their earnings call. Just remember, there are three things you always want to keep in mind here. Number one, if you want to go from zero to millionaire in real estate investing, check out the real estate investing course linked down below. It's amazing. Great way to get you started. If you need life insurance, go to metkevin.com/life with one E, metkevin.com/life. And if you want 12 free stocks, go to metkevin.com/free. But this by far is the most popular course. You'll lock in lifetime access. I'll do fundamental analysis with you as well in our course member live streams. We do every day the market is open. And then when there are deals to analyze, we'll analyze deals. So check that out. It's most popular to bundle that with the Zero to Millionaire Real Estate Investing course. New orders decreased 10% at Lennar, and this is what you're seeing, is you're seeing a decrease of orders, a decrease of volume, but average selling price is holding up. And a lot of these companies actually are receiving or seeing a lot of sustained margins. One of the reasons they're seeing sustained margins is actually because they bought a lot of their land in 2019 and 2020. That's the land that is being sold with homes on it now in 2023. The problem is those prices were a lot lower than they are in 2023 for land. That means stuff that's now being built that'll end up coming out in 2025 will be being built on very expensive land with potentially lower sales prices, or even if we're at stable sales prices at 25, what you end up having is a situation where margins at these home builders are really expected to plummet. So you want to be careful with some of the home builders, in my opinion, at this point, especially since there's also there are rumors and speculation of dare I say near fraud, and this is just rumor and speculation, and I'll give my opinion on it. But basically what some home building sales reps are saying is that you could end up having home sales reps, and what the home sales reps are doing is they're potentially putting people under contract. You see, they're putting people under contract whom they know are not qualified to actually buy those homes. So eventually the shoe will drop when those deals cancel and the under contracts go away. Now all of a sudden the appraisals end up getting hit for existing transactions, other existing transactions and new ones. And when the appraisals get hit, now the builders actually really have to start reducing prices, and then you actually get a pricing war at the same time as you get a surge of inventory. Look, let me be very clear about this, okay? And I'll be clear with my bias as well, okay? if here's what you are hoping for. If you are a bear, what you want is you want a surge of inventory. Nobody can determine what's going to happen with rates, but I promise you, if we get an institutional or a home builder surge in inventory, the bears are going to win here in real estate. If you are a real estate bull, you think and believe that the amount of buyers we have, while it may be lower, will be enough to offset the surge in inventory, especially since a lot of the move-up market or move-down market, the homeowners, aren't wanting to get rid of their low rental rates. So they're actually turning properties into rentals. The problem with this is, as people who are keeping properties are turning properties into rentals, you're actually seeing downward pressure on rents. That's statistically what we're seeing as well, whether it's what we're expecting to see through owner's equivalent rents or what we're already seeing through apartment list, vacancy rates up, rents down, Zillow leading indicators for rents are coming down, rents are trending down. That actually is also dangerous because it suggests that if you're looking at rental property, you should be very conservative with what you are renting out properties for, what you're projecting for your property rentals. Now, I'm going to give you a couple anecdotes here. First, I want to be very clear about my bias. I have a housing startup. We don't know if our Reg A will go through. If it does, then we can raise money from non-accredited investors probably in May. Otherwise, if you're an accredited investor, we close the accredited investor round in 2 weeks. So that's it. People have 2 more weeks to put money into HouseHack as an accredited investor, and that's it. But what our goal at HouseHack is we don't actually care if prices, how much they fall. Of course, we'll get a better deal because they've already fallen a lot. But we would rather buy slightly on the uptrend than catch a falling knife with the startup. That's very important for us. So I don't really care. If prices keep going down, we got cash. We'll take the money. If prices stop falling, I get to go to work sooner because we're just sitting on nearly $30 million in cash. And, we might raise another 20 to 30 more if we do our Reg A. So the point is, it doesn't matter to me. If prices keep going down, we wait. If prices stop going down, then we start buying, right? So the point is, I want to be very clear with my biases because I don't care what the answer is. I just want to know what the truth is. And there are a lot of real estate bears who are telling you the sky is falling, and that's not what I'm seeing on the ground. I don't think there's anybody else who's actually visited as many different cities as I've gone to in the last 2 months. You could look up my flight history. Just Google it. Just go into Google, type in N88W Flight Aware. Flight Aware N88W. Go to flight history. Look at my flights. I'm fully transparent about where my plane is, which I pay for, not my startup. So you could see all the markets I'm going to. I don't think anybody else is doing that. And I'm in every single one of the markets. And I'm not seeing people deathly fearful of the bear case, but I'm also not seeing people super bullish. Things are pretty neutral right now, which is very interesting. So that's why I'm reporting this the way I am, because that's just the reality of what's going on. Now let's go jump on over to the earnings call, which I've been talking about here. Stalking Kevin. Look, you could pay to hide your flight history or whatever, but I actually think it's good to be transparent. But anyway, so what do we have here? Okay, here's Lennar's earnings call for you. What do they tell us? Well, first they tell us we purchased very little land this quarter as we await for better pricing in line with current home sales prices. In other words, Lennar is telling you we are going to wait. We are going to wait to buy. Now, that's very interesting because here you have a home builder telling you, we're just not going to buy land right now. We'll buy back our stock instead. Very interesting. With our balance sheet strong, we'll be able to continue with stock repurchases, right? Some markets are performing well. However, in most of our markets, we've had to adjust prices, increase incentives, or provide mortgage buy-downs. That's another thing that's propping up the market right now. Mortgage buy-downs. What else? Our cancellation rate is 21%. It's still pretty dang high. It's down from 26% though. Look at the specific markets that are doing well. Like this market right here. Kevin's course member market. The Zero to Millionaire Real Estate Investing course with the expiring St. Paddy's Day program linked down below, where if you get in, you guarantee the best price. And the price goes up after that coupon expires. Oh, wait, sorry. We've had 10 markets that are performing well. Southeast Florida, Southwest Florida, Tampa. I was just there. So I grew up in Southeast Florida. Southwest Florida is like more like Naples and that. But I grew up in Southeast Florida. I just visited Tampa. That's interesting. That's very interesting because that's what I've seen as well over there. Palm Atlantic. This is where I met Kathy. Kathy Wood. Anyway, New Jersey, Philly, Charlotte, Coastal Carolinas, Indianapolis, I believe, and San Diego. Now that's very interesting. The Category 2 markets, the markets where we've made more significant adjustments. This is like hurricane categories here, huh? No Category 3 markets. Oh, that's good. Okay. So you've got Category 1 markets that are performing well, and then you've got Category 2 markets that are not doing so hot. Those markets include Jacksonville. I was just there. Orlando. I was just there. Northern Alabama, Atlanta, Raleigh. I'm going to Raleigh soon. Virginia, Maryland, Chicago. Going to Chicago soon. Minnesota, Nashville. Going to Nashville soon. All the markets in Texas. I'm in Texas literally right now filming this video. I was just in San Antonio yesterday. I'm in Austin today. Dallas, Fort Worth probably tomorrow, TBD. Anyway, Colorado. I've been there like 4 times. Phoenix, been there like 5 times. Vegas, been there like 5 times. Tucson, haven't been there yet. And the rest of California and the Pac West, including Seattle, Utah, Reno, Boise. I've been to all of those places, all within the last 2 months. While inventory is limited in each of these markets, yes, we had to offer more aggressive financing programs and base price reductions or increase our incentives in the area. Very interesting. In some cases, to avoid cancellations, we've had to adjust our pricing on our existing contracts or our backlog or our new deals and the existing contracts. Continue to make progress on reducing trade costs. This is what makes me very excited about my real estate startup too, is I think there are going to be so many opportunities because even if pricing for houses stabilizes, I actually think construction costs will come down substantially. Labor costs and material costs. This is a sign of disinflation right here. This is actually very, very good. So if you're looking for disinflation, it's right here. Fantastic. Lower construction costs, helping us on the business side, saving about $14,000 per home. Should help us with margins, yada, yada, yada. I'm trying to respect your time, so I'm going a little faster here. I'm just curious. Can you reconcile these comments about pricing, maybe finding a clearing price, so basically finding a bottom? So they say, we're looking at pricing on an everyday basis in each community. Hey, we've heard that before. All real estate is local, right? In a very granular assessment to reconcile what I've said about the end of February. At the end of February, interest rates started moving dramatically in a different direction. That's up. And we definitely saw a direct impact in traffic levels. That's down. We were intrigued to watch as we went from February into March. Now rates are coming down. But anyway, the sticker shock of high rates is subsiding. And so we think we're going into stability the first 2 weeks of March. I agree with that. That's roughly what I'm seeing as well. However, there is also a lot of fear about the banking sector. And if people think we're going into a financial crisis, in a weird way, rates could actually come down. But people might not buy real estate because while rates come down, they end up having fear about the banking crisis. It's entirely possible. So, bottom line, pretty neutral right now on real estate. Because rates are coming down, we have to see how that fear is going to lead to a change in inventory. That's actually perfect for my real estate startup because I've been saying for over a year and a half now that we're looking at buying real estate Q3, Q4, which we're very excited about. You can follow the journey, obviously, here on the channel. If you're an accredited investor, you have 2 weeks left to invest by going to househack.com. Read the solicitation there. This video is not a solicitation. And the non-accredited round may occur in May, subject to a green light from the SEC, which obviously we can't guarantee that we'll end up getting. But we will operate whether or not we have a Reg A. Obviously, I expect we will have a Reg A, but we have no way to guarantee that we will. So in the meantime, if you're accredited, househack.com. So that gives you some ideas about what's going on in the real estate market.